right, welcome back to Squawk Box, everybody. We are approaching January's ADP private payroll report. The futures ahead of that, Dow down by about 67, S&P futures down by 25, the NASDAQ off by 160. Steve Leisman is here, and he joins us with that number.
Betsy, thank you. The January ADP private payrolls estimated 183,000. This is the private payroll company ADP with its estimate of national private payrolls. And you can see there, goods not doing so great, but it's all in the service sector, 190,000. And there's the non-farm payroll estimate in and around exactly where ADP is at 169,000 for this Friday. They revised up December from 122 to 176. That's a little closer to where the government was with the BLS report. And then pretty good distribution across business size here. 39,000 for small business, 92,000 for medium, and 69,000 for large business. And then pretty good spread again across different industries again, but all in the service sector. Trade, transport, and utilities up 56, leisure and hospitality up 54,000. And education and health services up 20,000, with professional business services up 14,000. And there's manufacturing taking that a hit. I'm not sure exactly what's going on there. Maybe we'll ask Neela Richardson in a second. Key, though, here, these medium annual wage changes, job stayers 4.7. That's steady, and job changers up 6.8%. Just very quickly, some headlines from Tom Barkin from the Richmond Fed this morning. He says he still leans towards cuts this year, expects 12 months inflation to come down nicely, but he says there's a lot of uncertainty. It goes beyond just tariffs to immigration, regulation, and other issues. Becky?
All right. Thanks, Stefan. You called me Betsy at the top. I've only known you 25 years, Steve. You did. You called me Betsy at the top. These guys heard it. I know she's your producer. They took him away. Oh, now I feel bad. Steve doesn't get to play back with me. Anyway, joining us right now is Neela Richardson. She is ADP chief economist. Neela, let's run through these numbers. What jumps out at you? What should we be really paying attention to?
First of all, hi, Becky. I'll say it again. I think we should, first of all, underline the strength of the labor market. Now, remember, the January report for ADP and the numbers that you'll see Friday from the government have been re-benchmarked with a QCEW number that it pulls the numbers together for January. And so what I think you'll see from both ADP and on the Friday report is strength ending the second half of 2024 that carried over into the first month of 2025. But as Steve pointed out, you'll see that dichotomy between goods and producing and services. This is very much a labor market where hiring is led by consumer-facing industries, namely leisure and hospitality. So we're going to be seeing if that carries over through the whole year 2025, or if manufacturing can have a chance to rebound this year.
Hey, Neela, we have talked so much about how, DOGE is in effect. The government is looking to try and cut back on spending, cut back on employees. They are offering buyouts to lots of people throughout the government offices. I know you focus on private payrolls. Is there going to be a point where ADP does not necessarily match up with what we can anticipate from the Friday jobs report because government numbers are going to be such a big factor in this? Usually government is a plus and an upside to adding to those jobs reports, but we could see it really coming down in the weeks and months to come.
We've actually seen in the government numbers, not the government jobs, but the government numbers, a turn towards the private sector. Government and healthcare was carrying the BLS report for a lot of the months over the summer and the fall. But if you look at the end of 2024, it was really the private sector that was taking off and accounting for the majority of the job gains. And I think you still see that momentum in January. So clearly, I think for the first initial months of this year, it's really going to be private sector dominance, and that should be consistent between the two reports.
Okay. And if we were to look for any outliers throughout these numbers, what surprised you, if anything?
Construction. We're still in need of residential construction. There's still powerful trends when it comes to data centers and fueling AI, and that leads back into real estate. So I'm surprised to see that construction jobs were so short, only 3,000 this month. I really think it's tied to a labor shortage, not a shortage in demand. And so if we're going to see that support for housing, and remember, Becky, housing feeds into inflation. If we don't have enough housing supply, then we really need to see more job gains in construction to support that industry.
The median change in annual pay up 4.7% for job stayers, up 6.8% for job changers. That seems higher than some of the numbers I had seen recently. Is that an indication of inflation potentially coming back?
Yeah, so we've seen that job stayer number not budge really from 4.7%. And new this month, we actually increased our sample size by 5 million workers that we can uniquely match through time. So that's a 14.8 million sample size. And so there's a lot of data that has a very rigorous underpinning to that 4.7% number that we haven't seen a lot of movement in. And yes, that is much higher than it was before the pandemic. So wages are still elevated, and there is reason to be cautious about the future moves of inflation because wages are that bridge in terms of labor costs between the jobs market and inflation on the other side. So there's a right to be cautious here.